There's a theory in chaos mathematics called the butterfly effect. It says that a butterfly flapping its wings in Tokyo can cause a tornado in New York. In the financial world, this is not a theory. It is a mechanic. And right now, the butterfly isn't just flapping its wings. It is creating a hurricane. While the world is obsessed with the Federal Reserve, while everyone is watching the US election cycle or the war in Venezuela, they are missing the single most dangerous chart in global finance. It is a chart that has just broken a 25-year trend. It is a chart that signals the end of the free money era. I am talking about the Japanese government bond yields, specifically the 30-year yield. Today, it surged to 3.5%. The 10-year yield crossed 2.13%. These are numbers we have not seen since 1999. To the average person, this sounds boring. Bond yields in Japan, who cares? But to the institutional plumbing of the world, this is a catastrophe. Japan has been the global ATM for 2 decades. They kept rates at zero. They printed unlimited yen. Investors borrowed that free money and used it to buy US tech stocks, to buy US real estate, to buy crypto. Now the ATM is closed. The cost of borrowing that money just spiked. This triggers a global margin call. In this massive and 4-part investigation, we are going to explain why an interest rate move in Tokyo is about to crash the liquidity in New York. We are going to look at the carry trade, the hidden leverage that props up the S&P 500, and why it is unwinding right now. And we are going to explain why this liquidity shock is the final trigger that sends capital fleeing from paper assets and into silver. The system is breaking at the weakest link, and the weakest link is the yen. This is the story of the Japan shock. To understand why 3.5% is a disaster, you have to understand the game Wall Street has been playing since 2001. It is called the yen carry trade. Here is how it works. You are a hedge fund manager in New York. You want to buy Nvidia stock, or Bitcoin, or US Treasuries. But you don't want to use your own money. You want leverage. So you look around the world for the cheapest loan. You see Japan. The Bank of Japan has set interest rates at 0%, sometimes even negative. So hedge funds borrow 1 billion yen. It costs you almost nothing in interest. You convert that yen into US dollars, and you use those dollars to buy US assets yielding 5% or 10%. You pocket the difference. It is free money. Trillions of dollars, literally trillions, have flowed out of Japan and into Western markets through this mechanism. It is the liquidity engine of the bubble. Japan prints the yen, we borrow it, and we inflate our asset prices. But there is one catch. This trade only works if Japanese rates stay low. If Japanese rates rise, the cost of your loan goes up. Suddenly, the free money isn't free, and if the yen gets stronger against the dollar, you owe more money than you borrowed. That is what is happening today. The Bank of Japan has lost control. Inflation is forcing them to raise rates. The 10-year yield hitting 2.13% is the signal that the game is over. The hedge funds have to pay back the loan, and to pay back the loan, they have to sell the assets they bought. They have to sell the US stocks. They have to sell the US bonds. This creates a wave of selling pressure that has nothing to do with earnings or the economy. It is purely mechanical. It is a deleveraging event. Why is 3.5% on the 30-year bond so critical? Because it represents the tipping point for Japanese life insurers. Japan is a nation of savers. They have massive pension funds and insurance companies. For 20 years, these funds could not make any money investing in Japan because rates were zero. So they took their money offshore. They are the biggest foreign holders of US debt, French debt, and Australian debt. They own over $1 trillion of US Treasuries. But now, they can get 3.5% risk-free at home, in Tokyo. Without currency risk, this is the golden number. Japanese funds have stated for years that if domestic yields hit 3%, they would bring the money home. We are now at 3.5%. This means the great repatriation has begun. The Japanese pension funds are selling their US Treasuries. They are selling their European bonds. They are taking that capital back to Japan. This leaves a massive hole in the US market. Who's going to buy the US debt if Japan stops? The Fed? China? China is selling. The Fed is supposedly tightening. If Japan leaves the room, US interest rates have to spike to attract new buyers. Higher US rates break the US housing market. They break the US banks. This is the contagion. A rate hike in Tokyo forces a rate hike in New York. The world is connected by debt, and Japan holds the mortgage. We have a precedent for this. We don't have to guess what happens. We saw it happen recently. August 5th, 2024, Black Monday. The Bank of Japan raised rates by a tiny amount, 0.25%, and the global markets collapsed. The Japanese stock market fell 12% in one day, the worst drop since 1987. Crypto crashed. US tech stocks crashed. Why? Because the carry trade unwound too fast. Everyone rushed for the exit at the same time. That was a warning shot. The central banks stepped in and patched it up. But now, in 2026, the rates are much, much higher. The pressure is 10 times worse. The 30-year yield is at an all-time high for this century. If a 0.25% hike caused a crash in 2024, what does a breakout to 3.5% do today? It guarantees a liquidity shock. This is why we are seeing volatility in silver and gold. In the initial phase of a liquidity shock, everything gets sold. People sell gold to pay for their yen loans. We saw that drop on Monday. But once the selling is done, the fear sets in. This brings us to the silver thesis. Why is this bullish for silver? Because when the bond market breaks, the risk-free asset is no longer risk-free. If U.S. Treasury yields spike because Japan is selling, the price of the bond crashes. Investors who thought they were safe in government debt are losing 20%, 30% of their capital. They look at the volatility, they look at the currency wars, and they ask, where can I hide? They can't hide in the yen. It is volatile. They can't hide in the dollar. It is being debased. They can't hide in bonds. Rates are rising. There's only one place left: hard assets. When the global carry trade blows up, it destroys faith in fiat leverage. Capital flees from the leveraged economy to the real economy. Gold and silver are the ultimate unleveraged assets. They have no counterparty risk. They have no yield curve risk. They are immune to the Bank of Japan's interest rate policy. So, while the initial shock might be painful, the aftermath is a flood of capital into precious metals. This is exactly what happened in the 1970s. Rates rose, bonds crashed, and gold went to the moon. We are repeating the cycle. So the ATM is closed, the rates are spiking, the Japanese money is going home. But how does this play out in the US markets this week? How does it affect the silver price at $78? In part 2, we are going to look at the unwind mechanics. We're going to explain why this repatriation creates a shortage of US dollars in the short term, but a collapse of the US dollar in the long term. We are going to look at the US Treasury crisis. Japan owns $1.2 trillion of our debt. If they sell, the Fed has to print to buy it. This is yield curve control. And we are going to show you why this specific event is the catalyst that forces the Fed to pivot back to quantitative easing, setting silver to triple digits. The bond market is the fuse. The silver market is the explosive. Stay tuned for part 2. We are calculating the blast radius. If you're just joining us, let's reset the board. We have identified the catalyst. The Japanese 30-year government bond yield has hit 3.5%. This is the highest level since 1999. It signals the end of the carry trade, the decades-long practice of borrowing cheap yen to buy expensive U.S. assets. In part 1, we explained why this is a global margin call. But now, we need to talk about the destination of that capital. When the margin call hits, the money doesn't just evaporate. It moves. It moves from the west back to the east. It moves from the dollar back to the yen. In part 2, we are going to expose the repatriation vacuum. We are going to look at the $1.2 trillion of U.S. government debt that Japan holds. We are going to ask the terrifying question: if Japan sells our debt to pay for their own recovery, who buys it? And we are going to explain why this specific event forces the Federal Reserve into a corner where they have only one option left: yield curve control. This is not just a Japanese story. It is an American crisis. And it is the rocket fuel for the next leg of the silver bull market. Let's look at the debt. For 20 years, institutional investors invested in U.S. Treasuries because they paid 4%, while Japanese bonds paid 0%. You took the currency risk, you dealt with the time zones, you did it because you had no choice. But today, you wake up and see that you can get 3.5% risk-free at home in Tokyo. Without currency risk, it has no geopolitical risk. What do? You sell the U.S. Treasury, you bring the cash home, you buy the Japanese bond. This is repatriation. It sounds technical, but it is a giant sucking sound. It sucks liquidity out of the U.S. stock market. It sucks liquidity out of the U.S. housing market. And most importantly, it sucks liquidity out of the U.S. government. Japan is the largest foreign creditor to the United States. They hold over $1 trillion of our debt. If they decide to sell even 10% of that, that is $100 billion of selling pressure hitting the bond market. When bonds are sold, yields rise. When U.S. yields rise, mortgages go up, auto loans go up, credit card rates go up, the U.S. economy chokes. So, the rise in Japanese rates is effectively a rate hike for the United States, delivered from across the ocean. The Fed didn't vote for it, but they have to live with it. This tightens financial conditions faster than Jerome Powell ever could. And it breaks things. This leads to the Treasury nightmare. The United States government is running a deficit of $2 trillion a year. They need to sell bonds to keep the lights on. They rely on foreign buyers, China and Japan, to buy those bonds. But China has stopped buying. They are selling. And now Japan is stopping. They are selling. So who is left? Who buys the debt? Hedge funds? They are leveraged. U.S. banks? They are full. There's only one buyer left, the Federal Reserve. This is the trap. If foreign demand for U.S. debt collapses because Japanese rates are attractive, the U.S. Treasury market crashes. Rates go to 6% or 7%. At 7% interest, the U.S. government is insolvent. The interest payments consume the entire budget. So the Fed cannot let rates rise. They have to step in. They have to become the buyer of last resort. They have to print new dollars to buy the old bonds that Japan is selling. This is called monetizing the debt. It is the definition of printing money to pay your bills. When the market realizes that the Fed is the only buyer left, it realizes that the supply of dollars is about to go vertical. This destroys the value of the dollar. And what is the anti-dollar? Silver. This is why the Japan news is so bullish for precious metals. It forces the Fed to print, even if they don't want to. They have to print to absorb the Japanese selling. Japan is exporting its inflation to us. We need to define a term you will hear a lot in 2026, yield curve control. Japan did it for years. Now the US will have to do it. YCC is when a central bank draws a line in the sand. They say the 10-year Treasury yield will not go above 4.5%. If it tries to go higher, we will print infinite money to buy bonds and keep it down. This is the ultimate surrender. It means the central bank has given up on fighting inflation. They are prioritizing the solvency of the government over the value of the currency. Once YCC is announced, or even hinted at, the bond market becomes a zombie, and capital flees. Where does it flee? It cannot stay in bonds, returns are capped. It cannot stay in cash, inflation is uncapped. It goes to real assets. This is the mechanics of a crack-up boom. The economy might be terrible, but asset prices rise because the currency is being diluted to save the bond market. Silver is the primary beneficiary of YCC because silver has industrial utility and monetary history. It is the asset that cannot be diluted. Japan's move to 3.5% brings the US one step closer to inevitable YCC. The clock is ticking. But why silver, you ask? Why not just buy gold? Gold will do well, but silver has leverage on the industrial economy. Remember, this crisis started in Japan. Japan is a manufacturing giant. Toyota, Honda, Panasonic, Sony. These companies use massive amounts of silver. As the yen strengthens due to repatriation, Japanese purchasing power increases. This makes raw materials cheaper for Japanese industry in yen terms. It allows them to buy more commodities. So, a stronger yen actually supports industrial demand in Asia. It allows them to drain the global market of resources. Furthermore, silver is the people's hedge. When the average citizen sees their currency failing, when they see bond yields spiking, they can't buy a treasury bond. It's too complex. They can't buy a futures contract. They buy a coin. The retail panic we discussed in previous videos is fueled by this macro anxiety. When the carry trade blows up, it creates volatility that scares the public into safety. So, we have a dual driver for silver. Monetary. The Fed, printing to buy the bonds Japan is selling. Industrial. Japanese industry using a stronger yen to secure strategic stockpiles. Both roads lead to higher silver prices. So, the money is moving home. The US debt is unloved. The Fed is trapped. But what happens to the banks? The banks are the ones who facilitated this carry trade. They are the ones who lent the yen to the hedge funds. Now, the loans are going bad. In part 3, we are going to look at the banking contagion. We are going to see which US and European banks are most exposed to a Japanese rate hike. We are going to look at the derivatives book, The Quadrillion-Dollar Web of Bets, tied to interest rates remaining low. If rates spike, the derivatives blow up. And we are going to explain why this banking stress will force the Fed to cut rates. Even if inflation is high, the pivot is coming. Not because they won the inflation fight, but because they lost the financial stability fight. Silver loves a pivot. We are looking at the blast radius in the banking sector. We have tracked the earthquake from Tokyo to Washington. We saw how a rate hike in Japan sucks capital out of the US Treasury market. We saw how this forces the Federal Reserve to become the buyer of last resort. But there is a layer of the financial system that sits between the bond market and the real economy. The banks. The global banking system is built on a foundation of cheap money. For 20 years, they assumed that interest rates would stay low forever. They assumed that the Japanese yen would always be the funding currency for their risk-taking. They built a massive tower of bets on that assumption. Today, with the 30-year yield hitting 3.5%, that foundation cracked. In part 3 of this investigation, we are going to look at the banking contagion. We are going to open the books on the massive derivatives market, the shadow casino where banks bet on interest rates. We are going to explain why a spike in global yields blows a hole in the balance sheets of the too-big-to-fail institutions. And we are going to show you why this banking stress is the ultimate buy signal for silver. When banks wobble, people don't want bank deposits. They want physical assets. The crisis is moving from the sovereign level to the commercial level. Let's look at the blast radius. Let's talk about the sheer scale of the derivatives market. The notional value of global derivatives is estimated to be between $600 trillion and $1 quadrillion. Now, to be clear, notional value is not the same as the money at risk. The actual money at risk, the gross market value, is much smaller, likely around $20 trillion, but $20 trillion is still a massive number. Most of these derivatives are interest rate swaps. Here's how it works. A bank enters a contract where they receive a fixed rate and pay a floating rate. They are betting that rates will stay stable. They use massive leverage to squeeze profit out of tiny movements. But Japan just threw a wrench in the gears. By allowing their rates to rise, Japan is pushing up global rates. This moves the floating rate against the banks. When you're highly leveraged, even a small move against you can be painful. While we don't know the exact losses yet, we are seeing signs of stress. Norinchukin Bank in Japan recently reported huge losses from selling foreign bonds. U.S. banks are sitting on hundreds of billions in unrealized losses from previous rate hikes. The math suggests that someone is hurting. And in a connected system, when one counterparty hurts, everyone feels it. Let's look at the hedge funds. The hedge funds are the ones who actually executed the carry trade. They borrowed the yen. But who lent it to them? The prime brokers, the divisions of major banks that serve as hedge funds. If a hedge fund blows up because the yen spiked, the hedge fund goes to zero. But the loan doesn't disappear. The loss travels up the chain to the prime broker. The bank is left holding the bag. We saw this with Archegos Capital a few years ago. One fund blew up and cost Credit Suisse $5 billion. Now imagine if that happens across multiple funds. The exposure could be systemic. Banks might start realizing that their clients cannot pay. This leads to a credit contagion. Banks stop lending to hedge funds. They stop lending to each other. They hoard capital to plug the holes in their own ship. When credit stops, the economy stops. This puts immense pressure on the central bank to intervene, not to save the economy, but to save the banks from their own clients. This brings us to the Federal Reserve's nightmare. The Fed has a dual mandate, stable prices and maximum employment, but they have an unwritten third mandate, financial stability. Right now, inflation is still an issue. The textbooks say they should keep rates high, but financial stability is flashing yellow. The Japan shock is stressing the banks. History tells us that when stability fights inflation, stability often wins. The Fed will likely be forced to pivot. They might cut interest rates or restart quantitative easing to calm the markets. They might do this even if inflation is above their target. They will choose high inflation over systemic crisis. This is the rocket fuel for silver. Silver loves inflation. But silver really loves inflation caused by a policy error. When the market realizes the Fed has surrendered, that they have abandoned the inflation fight to save the banks, faith in the dollar weakens. Investors realize that their cash is being sacrificed to bail out Wall Street, so they trade the cash for metal. This is why we say the pivot is a panic. They aren't pivoting because they won. They are pivoting because something broke, and broken things require printed money to fix. Let's bring this back to your portfolio. Why does a banking crisis matter for a silver investor? Because of counterparty risk. If you hold silver in an ETF or a pool account or a futures contract, you have a counterparty, usually a bank. If that bank faces solvency issues because their yen carry trade blew up, your silver could be at risk. It becomes part of the bankruptcy estate. You become an unsecured creditor. But if you hold physical silver, you have no counterparty. A silver coin does not care if a bank is solvent. It does not care what the Japanese bond yield is. It is an asset that stands alone. During a banking crisis, capital flees from interconnected assets, stocks, bonds, derivatives, to bearer assets like gold, silver, and land. This is the flight to quality. We are seeing the early stages of this flight now. The premiums on physical coins are rising because people are waking up to the risk of leaving their wealth inside a stressed system. The Japan shock is the fire alarm. The smart money is checking the exits. The exit is a vault door. So the bonds are under pressure. The banks are stressed. The Fed is cornered. Liquidity might flood the system to prevent a collapse. What does this mean for the price of silver in 2026? In part 4, the conclusion of this series, we are going to calculate the price target. We are going to look at what happened to silver during previous liquidity injections. We are going to map out the path to higher prices. And I'm going to leave you with the final verdict on the Japan butterfly. It flapped its wings. Now the wind is picking up in the silver market. You need to be ready. The forecast is volatile. We have reached the final chapter of this investigation. We have traced the shockwave from the trading desks of Tokyo, where yields hit 3.5%. We have watched it cross the ocean to the U.S. Treasury market, forcing a sell-off in bonds. We have looked at the contagion spreading through the banking system and the derivatives market. Now we must answer the final question, the question that matters to your portfolio. What happens next? If the banks are stressed and the Fed is forced to pivot, where does the price of silver go? History gives us a roadmap. Every time the financial system breaks, whether it was 2008 or 2020, the response is always the same. The central banks print money. And when they print money, silver doesn't just rise, it explodes. In this final breakdown, part 4, I'm going to give you the price target analysis for 2026. We are going to look at the historical correlation between liquidity injections and silver rallies. I'm going to explain why the Japan shock guarantees that the United States will implement yield curve control, and I'm going to leave you with the final verdict on how to position yourself for the end of the carry trade. The butterfly has flapped its wings. The hurricane is here. Let's finish this. To predict the future, we have to look at the past. Let's go back to 2008. The banking system collapsed. Lehman Brothers failed. Initially, silver crashed. It fell from $20 to $9 because of the liquidity crunch. But then the Fed announced quantitative easing 1. They printed money to buy bonds. What happened to silver? It went from $9 to nearly $50 over the next 3 years. It was a 500% rally. Now look at 2020. The pandemic hit. The markets crashed. Silver fell to $12. Then the Fed printed $3 trillion. Silver went from $12 to $30 in 5 months. It more than doubled. The pattern is clear. Crisis causes a crash. The crash forces printing. Printing causes a rally. The Japan shock is the crisis. We are currently in the volatile phase where things are breaking, but the printing phase is inevitable. The Fed cannot allow the Treasury market to fail. When the printing starts this time, we are starting from a much higher base. We aren't starting at $12. We are starting in the 70s. A doubling from here takes us to $150. This leads to the macro endgame, yield curve control. Japan has been doing it for years. Now they are stopping. But the United States is about to start. As Japanese investors sell U.S. bonds, U.S. yields rise. The U.S. government cannot afford higher yields. The interest expense is too high. So the Fed will have to cap the yields. They will say the 10-year Treasury yield will not go above 4.5%. To enforce this, they will have to buy every bond that Japan sells. This is the death of the dollar as a store of value. It means the supply of dollars is infinite, but the yield is capped. Investors are not stupid. They will realize that holding bonds guarantees a loss in real terms. So they will sell bonds and buy commodities. This is the great rotation. Capital, leaving the sovereign debt market and entering the hard asset market. Silver is the smallest, tightest hard asset market in the world. When the bond refugees arrive, the price of silver will disconnect from reality. It won't be trading on supply and demand. It will be trading on monetary flight. So what are the targets? Let's use the ratios. We know that gold is trading near $4,500. In a monetary crisis, which is what yield curve control implies, the gold to silver ratio typically compresses. It goes back to its historical norm. The average in the modern era is around 40 to 1. If we take $4,500 gold and divide it by 40, we get a silver price of $112. That is the conservative target. That assumes gold doesn't go higher. If the crisis gets acute, if we see a bank failure, the ratio could compress to 30 to 1. 4,500 divided by 30 is $150. And if we get a true mania, a 1980 style panic, the ratio goes to 15 to 1. That puts silver at $300. So the roadmap is clear. Target 1, $100. Target 2, $150. Target 3, $300. We are currently trading in the 70s. This means we have a potential 2 times to 4 times return sitting right in front of us. This is the asymmetric opportunity. The downside is limited because the industry needs the metal. The upside is uncapped because the currency is dying. But I have to warn you, the path from $70 to $300 is not a straight line. It is a jagged, violent line. As the carry trade unwinds, there will be days where silver drops $5. There will be days where the margin calls force funds to sell their winners. These are shakeouts. They are designed to scare you. The banks want you to sell your physical position so they can cover their paper shorts. When you see a red day, remember the Japan shock. Remember that the global ATM is closed. Remember that the liquidity tide is going out for the fiat system, but coming in for the real system. Do not let volatility steal your position. If you are unleveraged, if you own the metal, you can ride out the storm. The only people who get hurt on a roller coaster are the ones who jump off in the middle of the loop. Stay in your seat. So here's the verdict on the Japan 30-year yield. It is the pin that pops the bubble. It marks the end of the era of cheap money. It forces the capital of the world to go home, and it forces the Federal Reserve to print the US dollar into oblivion to save the bond market. For the silver investor, this is the signal we have been waiting for. The macro tailwind is now blowing at hurricane force. We have the micro, Samsung, and solar shortages. We have the geopolitical, Venezuela and China. And now we have the macro, Japan, and bonds. The three pillars of the bull market are in place. There's nothing left to hold the price down except paper manipulation. And paper burns when interest rates rise. You have positioned yourself correctly. You understood the debt dynamics before the mainstream media did. Now, you just have to wait for the math to play out. The yen is moving, the bonds are breaking, and silver is next. Hold fast. The repricing event has begun. Subscribe.